One thing I commonly talk to my high-earning W-2 employees about is RSUs, restricted stock units, and how exactly are they taxed? Let's take a dive into it and take a closer look. There's actually two steps to the taxability of RSUs. The first part is whenever they vest, they are included in your W-2 wages as income. Now let's just say you're granted maybe 10 shares of stock. Your employer will sell off 1 or 2 shares of your stock to pay off your tax liability. So the taxes are also generally withheld on your W-2 whenever the RSUs are initially vested. Now the second component occurs whenever you go to sell the stock in that company, because that will trigger either a capital gain or a capital loss. Whenever the shares vest, you have what's known as basis in your shares. Now, we all know how the stock market works. Some days it's up, some days it's down, and the same goes for your individual stocks. Only sometimes these can be a lot more dramatic. So whenever they initially vest, if your stock loses value and then you decide to sell, you'll trigger a capital loss. You can use that loss to offset other capital gains, or if you don't have any capital gains, you can use $3,000 to offset your income. After a vest, if it immediately starts to gain value and then you sell, then you have a capital gain. Now, this is either a long-term capital gain or a short-term capital gain, depending on how long you hold the stock after it initially vests. So if you know someone who has RSUs and they're confused on how the taxability of those RSUs will work for them, tag them in this video so maybe we can share some knowledge with them.